Hello and welcome to the special segment known as MC Pro Select Stock of the Day. I'm your host Nikki Mirchandani, and in this segment, like always, we bring to you fundamentally strong investment stock ideas. Today we're going to be talking about Karur Vysya Bank, professionally managed old private sector bank from Tamil Nadu with a dominant presence in the SME segment in the southern state. The stock has been in a consolidation phase. The bank shares have slid as much as 10% against a 5% decline in Bank Nifty index over the past 3 weeks. What could have spooked the sentiment? Two reasons out there. The first one, decline in margin acted as a dampener where the bank witnessed a sequential decline in the operating margin. The cost of deposits rose faster than that of yield on advances. This trend, according to MC Pro, is likely to continue in Q2 as well. Nevertheless, the bank is looking to maintain margin profile above that 4% level. Cost pressure. Another one which is weighed on the stock performance, the bank has had a tad elevated employee cost in the quarter gone by on account of incentive payments to the employees. The bank is on a hiring spree to beef up resources for garnering deposit with a focus on CASA. This could result in elevated costs for a while as the benefits wouldn't be visible in the near term. However, MC Pro has multiple reasons for accumulating the bank stocks from a long-term perspective. Let's understand the first one. Business momentum. Growth in advances accelerated to almost 17% year-on-year basis. Besides that, corporate that continues to be on the slow lane as the bank has strategically shied away from interest rate war. The other components, like be it in the space of retail and SME, agriculture for that matter, have been well supportive. Second one, deposits have been catching up. Deposits made a comeback on year-on-year basis as well as sequential growth of 14% and 5% respectively. CASA share has declined to around 33% from 36.5% in the year-ago period. That remains an area of focus for the bank. Let's understand the other reason out there, which is the asset quality that remains to be strong. For the quarter gone by, the bank's slippage remains modest on the back of recoveries or the upgrades and the technical write-off. Net slippages were negative. In fact, the bank saw a reduction in the gross and the net NPA to 1.99% and 0.59% respectively, with a healthy provision cover of nearly 71%. Standard restructure assets stood at around 1.3% of the advances and carried a provision of roughly 24%. Bank expects asset quality to remain benign and has been guiding to a credit cost of nearly 75 basis points for the entire financial year. The other reason is the levers for ROA, or the return on asset expansion. ROA has already touched in 1.5% and MC Pro believes that the near-term upside looks capped. Having said that, the bank has levers to increase its unsecured retail book that is negligible as of now. It can tie up with MFIs to venture into this better yielding piece, which could support a higher yield on advances. With a low risk weighted asset density, the bank also has enough headroom to grow the unsecured high yielding book. Apart from that, the other area for focus would be core fees, where the performance has been lackluster. Also, the management is planning to give a push to third-party distribution. Let's talk about the valuation, the last bit in the piece, where for a decent ROA, the valuation currently stands at around 0.8 times 1 year forward book multiple, which seems to be reasonable. Well, with this, it's a wrap. Thank you so much for tuning in.